Understanding growth and jobs. Let's explore the economic indicators that move markets. Employment and growth data tell us if economies are expanding or contracting and how many people have jobs. These numbers drive central bank decisions and market movements. Why do traders care about these numbers? Simple. They move markets predictably. Strong growth and employment typically lead to higher interest rates, strengthening currencies, and pressuring bond prices. Weak numbers often cause the opposite reaction. Let's start with GDP, Gross Domestic Product. This measures the total value of all goods and services a country produces, showing if an economy is growing or shrinking. It's usually reported quarterly as a percentage change from the previous period. Gross Domestic Product growth. What does it mean? A country reports that its gross domestic product grew by 2.5% last quarter. What does this tell traders about the economy? What does 2.5% gross domestic product growth indicate? The economy expanded by 2.5% since last quarter. The economy shrank by 2.5%. Unemployment rose by 2.5%. Prices increased by 2.5%.
Yes, you're right.
Correct. 2.5% gross domestic product growth means the economy expanded by that percentage since the previous quarter. This positive growth shows that the country is producing more goods and services, which typically creates a favorable environment for businesses. Traders often view sustained gross domestic product growth as a positive signal for both the stock market and the country's currency. GDP comes in three versions: advance, first estimate, preliminary, second estimate, and final. Markets usually react most to the advance release since it's the first look at growth. Later revisions still matter if they significantly change the growth picture. Now let's turn to employment data. The monthly jobs report shows how many new jobs the economy created. This number directly reflects economic health. More jobs typically mean more spending, driving further growth and potentially higher interest rates. A country's monthly jobs report shows that 50,000 more jobs were created than economists had expected. How would markets typically react? What is the likely market reaction? The country's currency weakens. The country's currency strengthens. No significant market movement. Stock markets decline sharply.
Yes, you're right.
Right. When job creation exceeds expectations, it signals economic strength. Markets typically expect the central bank may raise interest rates sooner or higher to prevent the economy from overheating. Higher interest rates attract foreign capital seeking better returns, causing the country's currency to strengthen against others. The unemployment rate shows the percentage of the labor force without jobs. It's calculated by dividing unemployed people by the total labor force. Lower rates suggest economic strength, while rising unemployment often signals economic troubles. In country A, the unemployment rate drops from 8% to 7%, but the workforce participation rate also declines. What does this suggest about the health of the job market? What does this combination mean? The job market might be weaker than the lower unemployment suggests. The drop in unemployment confirms strong job growth. Neither metric provides useful trading information. Both metrics show equally positive news.
Yes, you're right.
Good insight. When unemployment falls but participation also declines, it suggests people are leaving the workforce rather than finding jobs. This indicates a potentially weaker job market than the headline unemployment figure suggests. Traders often look past initial positive reactions to falling unemployment when participation is also dropping, as it signals underlying economic weakness. Employment and GDP data affect all markets but in different ways. Currencies. Stronger data typically strengthens a country's currency. Stocks often rise on good data but may fall if interest rate increases seem likely. Bonds usually fall in price, yields rise, on strong economic data. Commodities. Industrial commodities often rise on strong growth expectations. Growth and employment data from major economies shape markets around the world. One key release is the United States Non-Farm Payrolls Report, published monthly. It includes job creation, the unemployment rate, and wage growth, all of which can move not only the United States dollar, but also global stock markets, commodities, and emerging market currencies. Similarly, gross domestic product data from China affects trade-sensitive assets across the world. Quick task. How markets react to NFP. Put in order what typically happens when the NFP report is released. Regions and countries release these indicators at different times, creating a calendar of market-moving events. US jobs data comes out on the first Friday of each month. GDP figures typically appear quarterly. Understanding this schedule helps traders prepare for potential market moves. Let's recap what we've learned. GDP measures total economic output, showing if an economy is growing or contracting. Employment data reveals job market health through new jobs created, the unemployment rate, and wage growth. These indicators drive markets because they directly influence central bank interest rate decisions and provide the clearest picture of economic strength or weakness. The power of price changes. After exploring employment and growth data, let's examine another critical economic indicator: inflation. Central banks pay extremely close attention to inflation, making it one of the most powerful market movers across all financial instruments. Inflation measures how much prices for goods and services rise over time. When prices increase rapidly, each unit of currency buys fewer goods. This erodes purchasing power and creates economic pressures that central banks try to control through interest rate changes. Why does inflation matter for markets? Central banks in most countries target moderate inflation, usually around 2%. When inflation rises too high, they typically raise interest rates to cool the economy. When inflation falls too low, they may cut rates to stimulate growth. A country reports inflation at 4.2%. Significantly above the expected 3.5% and the central bank's 2% target. How would this likely affect the country's currency in the short term? What happens to the currency? No significant movement initially rises, then completely reverses, weakens despite the high inflation reading, strengthens as higher interest rates become more likely.
No, the correct answer was
Strengthens as higher rates become more likely. Surprisingly, high inflation doesn't typically cause immediate currency weakness. Consider how inflation affects a central bank's likely next policy move. The Consumer Price Index, CPI, is the most widely watched inflation measure. It tracks the average price of a basket of consumer goods and services over time. Most countries release CPI monthly, and markets react strongly to unexpected changes in these readings. Beyond the headline CPI number, markets pay close attention to core inflation, which excludes volatile food and energy prices. Core inflation better reveals underlying price trends and is often seen as a more reliable indicator of long-term inflation pressures. Monthly Consumer Price Index data shows headline inflation at 5.1%, slightly above the expected 5.0%. At the same time, core inflation drops to 3.2%, below the expected 3.6%. What is the market interpretation? Focus on headline. Inflation pressures are rising, impossible to determine from these figures. Focus on core. Inflation pressures are easing, equal weight to both, neutral overall.
No, the correct answer was
Focus on core, inflation pressures easing. Markets do not give equal weight to headline and core inflation, especially when they send conflicting signals about price pressures. The significant drop in core inflation to 3.2%, below the expected 3.6%, suggests easing inflation pressures, despite the slightly higher headline number. This could reduce expectations for aggressive interest rate hikes, potentially weakening the currency and boosting stock markets, as investors anticipate a less restrictive monetary policy. The Producer Price Index, PPI, measures inflation from the perspective of sellers rather than consumers. It tracks price changes for raw materials, intermediate goods, and finished products before they reach consumers. PPI often serves as an early indicator of future CPI movements. Why watch both CPI and PPI? Changes in producer prices often pass through to consumer prices with a delay. Rising PPI may signal future consumer inflation, while falling PPI can indicate upcoming consumer price relief. This relationship helps traders anticipate future inflation trends. Knowledge check. Who measures what? Match each index to what it measures. Different markets react differently to inflation surprises. Currencies. Higher inflation expectations typically strengthen. Time for a quick quiz. Two countries both report 4% inflation. Country A's inflation comes from strong consumer demand and economic growth. Country B's comes from supply shortages and rising input costs. Try to guess. Which economy would investors likely favor? Neither attractive with 4% inflation. Both equally attractive. Country A, demand-driven inflation. Country B, supply-driven inflation.
No, the correct answer was
Country A, demand-driven inflation. Investors would typically favor Country A with demand-driven inflation. This type of inflation results from strong economic growth and consumer spending power, positive signs for corporate profits and investment returns. Supply-driven inflation, Country B, often indicates economic problems like resource shortages or supply chain disruptions, which can hurt growth and corporate profits despite similar headline inflation numbers. Trading inflation data effectively requires knowing both the previous reading and market expectations, distinguishing between headline and core inflation measures, understanding the central bank's inflation target and recent communications, monitoring related indicators like PPI for early signals, being alert to changes in inflation expectations. Inflation indicators rank among the most powerful market movers because they directly influence central bank policy decisions. By understanding how different inflation measures affect interest rate expectations, you can better anticipate market reactions across currencies, bonds, stocks, and commodities when price data surprises the market. See you in the next lesson. The business indicators. Let's turn our attention to indicators that reveal business and trade conditions. These reports often provide early warnings about economic direction before they show up in broader GDP or employment figures. The Purchasing Managers' Index, PMI, is one of the most important business indicators. This monthly survey asks business managers if key activities like production, new orders, and employment are improving or worsening. The responses create a single number that instantly shows business conditions. PMI readings work on a simple scale. Numbers above 50 indicate business expansion, while readings below 50 signal contraction. The further from 50, the stronger the trend. A reading of 55 shows solid growth, while 45 indicates significant contraction. Imagine you're analyzing market conditions. Employment data looks strong, but you notice manufacturing activity has declined for 3 straight months. This contradictory signal might warn of future economic weakness not yet visible in headline figures. The Purchasing Managers' Index, also known as PMI, for a country drops from 53.2 to 48.6. What does this suggest about the country's manufacturing sector and overall economic direction? What does this PMI change mean? Manufacturing is now contracting. The data is insufficient to interpret. Manufacturing is still expanding. No significant change in conditions.
Yes, you're right.
Correct. The drop from 53.2 to 48.6 shows that manufacturing has shifted from expansion to contraction. Any Purchasing Managers' Index reading above 50 indicates expansion, while readings below 50 signal contraction. This significant move below the critical 50 level suggests that manufacturing activity is now shrinking, potentially signaling broader economic weakness ahead. Markets typically react to PMI reports in these ways. Strong PMI readings boost the country's currency and stock market while pressuring bonds. Weak PMI readings typically pressure the currency and stocks while supporting bonds through expectations of potential rate cuts. A country reports its Manufacturing Purchasing Managers' Index at 48.0, indicating contraction, while its Services Purchasing Managers' Index comes in at 53.5, indicating expansion. Services represent 75% of this country's economy. What is the likely overall economic direction? Still growing despite manufacturing weakness, heading into recession. Impossible to determine from these numbers, already in recession.
Yes, you're right.
Good analysis. With services, which make up 75% of the economy, expanding at 53.5, while manufacturing, a smaller portion, contracts at 48.0, the overall economy is likely still growing. The much larger services sector's expansion outweighs the weakness in manufacturing. Traders often focus on the Services Purchasing Managers' Index in developed economies precisely because it reflects a larger share of total economic activity. Next, trade balance reports show the difference between a country's exports and imports. A surplus means a country exports more than it imports, while a deficit indicates the opposite. These reports reveal both domestic demand and foreign appetite for the country's products. What drives trade balances matters as much as the headline number. A surplus from strong exports suggests economic strength, while a surplus from collapsing imports often indicates domestic weakness. Similarly, deficits from strong imports, high domestic demand, differ from deficits caused by weak exports. Time for a quick quiz. A country's trade deficit suddenly shrinks by 50%. Looking deeper, exports remained flat while imports fell sharply. What does this pattern indicate? Improving export competitiveness. Balanced economic expansion. Strong economic growth. Domestic economy likely weakening.
No, the correct answer was
Domestic economy likely weakening. The composition of trade balance changes provides important clues about underlying economic conditions beyond the headline figure. A shrinking trade deficit caused by falling imports rather than rising exports typically indicates domestic economic weakness. Sharp import declines often reflect reduced consumer and business spending power within the country. Finally, retail sales data shows consumer spending at stores and online. Since consumers drive roughly 70% of developed economies, this monthly report provides crucial insight into economic health. Strong retail sales typically support economic growth, while weak consumer spending often precedes broader economic problems. Monthly retail sales unexpectedly fell by 1.2% overall, but when excluding automobiles, sales rose by 0.4%. What does this pattern suggest? Consumers are shifting from physical stores to online shopping. Beginning of a consumer-led recession. Specific weakness in the auto sector rather than a broader consumer pullback, statistical error in the data collection.
No, the correct answer was
Specific weakness in the auto sector rather than a broader consumer pullback. When retail sales data shows significant variation between categories, it offers specific insights about consumer behavior patterns. When overall retail sales fall but rise excluding autos, it typically indicates specific issues in the automotive sector rather than a broader consumer spending pullback. This pattern suggests consumers continue spending in most categories, positive sign, while car sales face sector-specific challenges. Putting it all together, business and trade indicators provide valuable early signals about economic direction, often warning of changes before they appear in GDP or employment data. By monitoring PMI reports, industrial production, trade balances, and retail sales, you can spot potential turning points that create trading opportunities across multiple markets.